Okay, so myth number 6 is that lender's mortgage insurance, or LMI for short, is a bad idea. And this is a big one. There are successful investors that I know that have got significant property portfolios that have said you must have a 20% deposit to invest or you shouldn't invest because LMI is bad. So why is LMI not a bad idea?
Oh, first of all, it can allow you to hold on to more cash so you can get into the next deal quicker. Number 2 is that usually the cost of your property will outperform the cost of LMI anyway. Number 3, once you understand inflation, well, I don't want to go too deep onto inflation, but debt is irrelevant with inflation, let's be honest, so it will just erode away. And number 4 is that the LMI can also be added in to like the overall 30-year mortgage as well. It's literally a tool that I have personally used to fast track my wealth and go hard. But I don't have much fear around property though either, because I understand property. Usually people that have this assumption or this belief system that LMI is bad comes from, an extra cost. But that extra cost can literally be a tool to go faster and quicker.
Yeah, a lot of people think, it's dead money. A lot of people think it's dead money. They're like, why would I pay lender's mortgage insurance? It's just another cost, dead money. It's like, well, it's not really. LMI gives you the ability to put less of a deposit into the property. So it's not dead money at all. In fact, it's a tool that is allowing you to buy more property with less cash, right? And so the net actual risk putting a low deposit in a property is so ridiculously low that it's hard to even quantify realistically. Now, to be fair, your mortgage payments would be higher because you've got more debt. So there's an element of that you've got to consider. But from a risk management perspective, there's bugger all risk there. Now, from a cost perspective, is that generally speaking, it gets rolled into the loan. And if it gets rolled into the loan, who's paying for it? Your tenants. So let's say the LMI was $5,000 or $10,000. I don't really care, whatever you want to say. And that gets added to your loan. So you've got a $500,000, let's say you've got a $500,000 loan that's suddenly getting another $5,000 or $10,000 added to it. Okay, cool. Over 30 years. Okay, got it. And you're not even going to pay that mortgage. Why do you care? Because your tenants are going to pay that mortgage. So who cares? And $5,000 or $10,000 spread over 30 years, even with an interest rate on it, divided by, so it's spread it over the 30 years and then divided down into monthly payments, you're talking such fractional amounts of cash that it is
probably the cost of a coffee.
Exactly. Probably the cost of a coffee or something like that each month. So you can literally double your return on invested capital by using LMI. Now, I'll put a caveat on this. You need to think about whether that is the right approach for you. Now, for a lot of people when they're getting started, maximizing return on invested capital is number 1, the goal, and 2, the preference, and all of this kind of stuff. If accelerating your return on invested capital is important, probably because you're starting out and you're trying to get ahead as fast as possible and all of that kind of stuff, then you're probably going to be like, hell yeah, let's do this. Creating these false beliefs can actually really, really hold you back. Do you have anything else you want to add to that?
Yeah, and to the point of the successful business person who's able to put in larger deposits, most people aren't in that situation and can't do that every single time.
Bingo.
So
yep.
I definitely couldn't. It's just the harder way. I think you're getting your highest ROI on your invested capital is literally the smartest number 1 metric that I'm always consistently trying to measure at the start.
Yeah, I mean, me personally, my strong preference is to maximize my ROI and to increase the diversification. So if I had, let's say I had $500,000 in cash and I could go buy 5 properties with a 20% deposit or 10 properties with a 10% deposit. Like,
I'd take the 10 diversify any day.
Yeah, I'd be like, okay, give me the 10. Like give me the 10 because, from a portfolio basis, the likelihood is I'm going to get significantly greater returns. So my ROI in each property will increase. Even if one of them was a dud, it wouldn't matter as much because I'd have a broader diversification in my portfolio and a higher return on invested capital. And so there are limits to this, by the way, right? And you really got to think about leverage strategically and not haphazardly. I think Warren Buffett or Charlie Munger, one of those two guys, said there's only 2 things that make wealthy people broke, and that's leverage was one of them, right? Leverage was one of the 2. But what they're talking about though is leverage on stocks, all right? Leverage on shares where there's a higher volatility. But the benefit of housing is you don't have that level of volatility. You don't have that level of risk. and you don't have margin calls in Australia. It's very different, obviously, in the US, but also you have no recourse lending in the US. So, whatever, you just walk away, which is crazy. Anyone who's sitting there, particularly if they're early in their portfolio and they're thinking, oh, I don't want to use LMI, I need a 20% deposit, maybe take that opportunity to reframe your thinking because you could be holding yourself back.
And if you're someone who has equity in an existing home and you're starting out to try to buy your first investment property, maybe you already have enough capital within your home or PPR that you might be living in to not have to do that to begin with. And that's something also that I would just work closely with your broker as well, because it's also a balance of pulling out too much equity also that might hinder your borrowing capacity and bring that down. So that's something that you'd have to balance out.
Myth number 7 is that you need to get out of a fixed, or you need to wait until your fixed rate has finished before you can refinance the loan and pull out equity. What do you mean by that?
Yeah, I think this has been a lot more common recently because there's been a lot of people in the last 12, 24 months who locked in at lower rates. So during 2023, going into 2024, probably got a larger cohort of people locked into a fixed rate. Now, a lot of people assume that they need to wait for that fixed rate to end before they can go and get a pre-approval or pull out equity. That's not true. So it depends on the flexibility within your existing loan terms. There's actually most amount of lenders will allow you to pull out equity and still be locked in to say, well, sure, you just want to take more money. So we'll extend it, give you more money now. And it just might mean you need to go get a pre-approval with somebody else. Who cares? So yeah, you don't have to be locked in. You could pull out equity and get a pre-approval much earlier.
The way to think about this, right, is there's the break fee, right? And so a lot of people think if you want to break your fixed term, you're probably going to have to pay a penalty fee, right? Which is why I don't like fixed term loans generally, right? And my opinion, not financial advice, do whatever you want, right? Personally, when there's a break fee attached to a fixed interest loan, they're pricing in the differential of if it was a variable rate, right? So they'll price that in. So broadly speaking, the chances are if you plan to refinance at any stage, you're probably just better off going variable, even if the rates go up. Right, you're probably still better off. But the thing you got to think about is, let's say you've got 2 years left on your fixed rate term, and let's say it's going to cost you $10,000 to break as a break fee. Now, in the first instance, you'd be like $10,000. I'm not going to pay $10,000 just so that I can refinance a loan. Okay, fair enough. But what you're actually saying is, if I pay $10,000, I can unlock my ability to continue to borrow and build my property portfolio faster. Then you've got to think about, well, what would I be able to do in that 2-year period? And what would the compound rate on the properties I buy, would that be worth more than $10,000? So I would say don't even be scared of that if you can afford it.
I did that. I paid $6,000. Yep, to get out of a loan. I think I had 4 or 5 months left. I was like, yep, makes sense to do it. I'm going to make more money over here instead.
Yeah, and guess what? Sometimes you've got to pay money to learn lessons.
I love making those mistakes too. Mm-hmm. I get to celebrate that I never have to make that again. Yeah,
exactly. Love that. Number 8, second last one. Debt is bad.
Probably one of our favorite excuses that we share. Similar to LMI.
Yeah. What's your take on this first before I riff on it?
Look, to me, you know what? Actually, 3 years ago, Goose, you actually asked me, what's your position on debt? And I said, debt is an asset to me. Debt is leverage, and it's a tool to fast track you to get to build wealth. Doesn't matter if it's in business or in real estate. And I love debt purely because I can use other people's money, OPM, other people's money to fast track. And debt is also tax-free as well. But let's just say, for example, you wanted to increase your wage by $10,000. That's earned income. You pay taxes on that. Whereas if you go in and ask the bank for an equity release to do the same thing, that would be tax-free. You wouldn't pay income tax on that. And also, I have a fair good understanding of inflation and that debt is irrelevant with inflation. Such a big, powerful sentence, that sentence. That for me, I personally, non-financial advice, my personal opinion, I actually have a goal to obtain $10 million worth of debt with the hope that will just have a pretty good indication of the future, that it will just erode away over time, that debt will. That's where my mind is. And we're conditioned to believe that debt is bad. It's not.
I know. Yeah, it's crazy. I think debt's one of the best things ever. I'm a big advocate of debt, right? Yeah, you got to be careful, right? You got to be careful. You got to be. So what kind of debt? Okay, so credit card debt probably not great, right? Because it's quite short term and it's quite high interest rate. Getting debt on a depreciating asset, not good, So getting debt to buy like car finance, that's not good. That's not smart. Even though, to your point, inflation devalues debt over time, the reality is on most like car loans and stuff like that, the time period is not long enough and the rates are too high and the underlying value of the asset depletes at such a rate that the differential between those two things is not useful, right? You still end up net negative. Same thing on boat finance, right? And things like that, right? So unless there's a way to make money from it, then it doesn't make a lot of sense. Now, you can then look at depreciating assets and then say, well, could I make money from this? If you're getting debt to buy a property, that's great, right? Because the underlying asset is going to be going up in value, or most likely at least not going down in value. There's going to be income associated with it. You're building an asset base. Short-term debt tends to be not as good as long-term debt, right? So give me as much debt as possible, put it on the longest terms, and off we go. Happy days, right? Short-term debt tends to be less advantageous. So depending on what you're borrowing it for, that's going to indicate whether or not it is good. And to your point, by the way, it's one of the best ways to be able to access capital on a tax-free basis. Because if you have a property that goes up by $100,000 and then you refinance $100,000 of equity out of that property, that's not income, right? You're not paying tax on that. That's debt, right? So there's no tax associated with it. So all of a sudden you get $100,000 tax-free that you then get to use somewhere else, preferably for another investment. And then, by the way, if you've taken out of an investment property, your tenants are going to be paying that mortgage, and the interest that you're paying on that $100,000 that you took out is tax deductible as well. So you've taken $100,000 out, you're paying no tax on that $100,000. You then get to put that $100,000 into something else that's going to make money, and the interest that you're paying on that is tax deductible.
Oh.
So it's like it's free money. Like, it's crazy. Like,
3 birds with one stone.
I know, it's insane. And so, like, one of the best things you can do, in my opinion, is to understand how to use that strategically and use it to your advantage. Now, just to be clear, just so we're all on the same page, that doesn't mean necessarily, depending on where you're at in your stage of wealth development, that you should have everything leveraged as hard as you can get it, right? Because that can create an unhealthy portfolio over time. But depending on what stage you're at, that might actually be a solid move. You may actually want to like redline it. Like, what's the maximum amount of debt that I can get on every property I buy so that I can go as fast as possible? Then let your portfolio rest and then let it grow itself back into a bit of health and get down to, a good portfolio LVR is probably going to be between, 60 and 80% over time. I think if you're any less than, say, 60% leveraged in your portfolio, or even 70% maybe, like, it's lazy. Like, it's lazy. Even an established portfolio, like, you've got inefficient capital sloshing around in your ecosystem that you're not putting to work in the right way and getting the right returns on. It's one of the biggest secrets to the wealthiest people on earth is that using debt strategically is the fastest way to get ahead.
Like, most people end up with, you could literally have $5 million worth of debt, but be cash flowing $200,000 of passive income, and was your original goal. Then who cares about the debt? Yep,
totally.
I had another scenario this week, actually. Aaron, it's the same sort of thing with like the interest rates, where you might need to cop a higher interest rate to begin with in order to get the next deal across the line. Mm-hmm. But then usually a few months after that, 6-12 months later, you can go refinance, move to another lender and get the lower interest rate.
The interest rate is tax deductible. This is what everyone forgets. It's like, oh, I got to pay a high interest rate. It's tax deductible. When you're starting out is the hardest part, okay? And most people are starting out. So statistically speaking, most people are starting out, right? Starting out is the hardest part. But once you actually start to get some traction, the two biggest things that you can do to accelerate your wealth: reduce your taxes and increase your debt. It's pretty simple. More debt, less taxes, right? It should be the mantra. More debt, less taxes. I might actually get that on a t-shirt. And if you can do those two things, you're gonna move a lot quicker. We've got one more myth that we need to get through. Sydney and Melbourne are the only place for high growth. Gee whiz, a lot of people would have you believe that. A lot of people would say things like billionaires wouldn't invest in a shack in Upper Kambukta West. They're only going to buy properties in Bondi Beach, right? But that's just not true, is it? Particularly if you look at the last couple of years. What's your take on this?
My take on it is I built a multi-million-dollar property portfolio off not buying in either Melbourne or Sydney.
Correct.
So it's not true at all. And if there's opportunity, wherever the opportunity is, that's where I'm going to go.
Yeah. But there's 15,363 suburbs in Australia now. It's gone up a little bit. Like there's always somewhere that's going up. There's always somewhere that's going down. There's always going to be optimal performers. Sometimes those suburbs are going to be in Melbourne and Sydney. That's normal. But sometimes they're not. Sometimes they're going to be other places. And also there's going to be, even if they are in Sydney and Melbourne, there's also going to be other places that are also growing. It's not like they're only growing in Sydney and Melbourne. It's just that that's the centricity of our media that say, look at this is going up. And so it creates this belief that the only way that you can get ahead is to buy blue chip in a ring, all of this kind of stuff. And to be fair, if you have lots of money and no information, so for example, let's say I had $50 million in cash and I didn't have Dashdot and I had no idea how real estate worked, and I just didn't understand the market at all, I would probably buy in Sydney and Melbourne. Right? I'd be like, all right, it's probably a safer bet. That's quantified on two things. Number one, tremendously high amounts of cash. And number two, no ability to understand how the market works. And if you have an ability to understand how the market works, then all of a sudden you can become what's called an informed investor. And then you can realize that there's other better places to put your money. Because I mean, Sydney and Melbourne become any market that becomes relatively unaffordable, so to use that term in the context of relative local affordability, becomes more volatile because inherently people aren't able to sustain. They're constantly at the limits of sustainable affordability. We looked at a suburb comparison between a suburb in Western Australia, which let's say, I can't remember the exact numbers, but let's say the median house price was like $450, something like that, and the median local income was, I can't remember exactly, let's call it $1,500, right? Or let's say it was $2,000, whatever it was. Then we looked at, I think it was New Farm in Brisbane or one of the inner ring Brisbane suburbs. The median house price was $2.5 million and the median household income was the same as it was in WA, right? And it's like, okay, so the prices are like 5 times-ish more expensive, but the income is the same. Tell me how that's a more stable market. That doesn't seem like it's going to be more stable to me, right? So not only is it not necessarily the place for high growth, it's also a higher risk proposition in my point of view. Depending on where you're at in your portfolio. This is not to demonize those markets because there is a place for those, but typically like this belief that you have to go there to get the growth is just a farce.
Yep. And that's something that I've seen, like the results of what your team find when I'm looking at the ROI and the growth that everyone's getting. I'm like 30%, 40%, 60%. I was like, this is wild. And this is what everyday Australians are getting outside of Melbourne and Sydney areas. And whenever that time, to your point, comes in your journey where it makes sense and the area and the data makes sense to buy in those areas, awesome. But I just wouldn't restrict yourself to saying, well, this is what I believe because this is what the data has shown me in the media for the last 20 or 30 years, or mum and dad have told me this is the only place you can buy. I would be open to quantifying that and grabbing the data and reach out to experts like yourself and your team.
100%. The other thing as well is like that belief stops people investing, because if you believe that Sydney and Melbourne are the only place to get growth, right, which is naturally what you want, and if the median house price is $1 million, then you're going to say, well, unless I can buy $1 million property, there's no point, which is not true. And so realistically, you could be getting into the market at much less than that. And so as a bit of a kind of market insight at the moment, I guess, below $450,000 right now is very hard to find high quality assets. But if you're at, say, a $500,000 price point or $550,000 price point, which is basically half Sydney and Melbourne, you can buy great properties. You can buy great properties that are going to perform exceptionally well. And so you could get in at half the price or less than what in Sydney, Melbourne, because Sydney, Melbourne, those median house prices might be 1.2, 1.3, 1.4, 1.5. You can get into the market for half the price and go twice as fast potentially. I mean, it's crazy. So letting go of that belief and understanding that there is a whole country to invest in is going to be the fastest path, one of the fastest ways to accelerate portfolio as well.
Yep. Amen. You know what? Most people would also know like an area as well where they're like, there's a good side and a bad side to an area as well. And the same thing goes with all of Australia. There can be a good side and there could be a bad side to a particular state even. Yes, there we go. Miss number 9.
Miss number 9. It's been a marathon. We've got through all 9. How do you feel, Liv?
I feel good. I feel really content that hopefully there are a lot of people that have listened to the last 2 episodes this is like driven them to decide, you know what, just gonna not assume and just ask a question. You can reach out to an expert.
100%. And so speaking of reaching out to experts, of course, if you're ready to invest, then of course, head to dashdot.com.au and book a discovery call with our team. But if you're not sure, if you're at a stage where you want to get some advice, you need a coach, you want someone to help guide you through that process, Liv, where would they get in touch with you? How would they reach out to you?
Just any social media platform. Just look out for
any
Olivia
social
Ward.
media platform. Olivia Ward is she's everywhere. She's all over the place. But to be fair, if you go on any social media platform, Instagram, anything like that, and you search for Olivia Ward, you are going to find her. And so ping her a message, get in touch, because having someone to talk to is sometimes the biggest issue. Most property investing is a lonely sport. So having someone that you can reach out to and say, hey, I need some guidance, I need some advice, I need some coaching to get me through this, to help me get started, can be one of the best ways that you can get started on your property portfolio. And obviously, we've been working very closely with Olivia for the last few years, and it's a great partnership and a great relationship. And I'm a big advocate of everything you do, Liv, and all the people you help. So if anyone is thinking about that, then I encourage them to reach out and connect with you as well. So
thanks, Goose. Likewise.
Thank you.